Good morning, America. This is Hubert Johnson with Taxes Made Easy. Today, we're going to talk about tax liens. There's a couple other things that happen in collections, but today we're going to focus on what are they, why are they filed, how to avoid them, and how to remove them. What can you do just because a tax lien's filed? Does that stop you from buying, selling property? Absolutely not. So you can still do many things even though there's a tax lien involved, and most people don't know that. So that's what we're going to be covering today. If you have any questions, again, reach out to us through our website, guardiantaxlaw.com, or 520-485-7371. And we're going to really kind of do a deep dive into tax liens and how to what are they, how to deal with them, and what are your options? And you still have options and rights. Good morning. Welcome back to Taxes Made Easy. I want to thank everybody that's watching either live or on rebroadcast. I'm feeling a little under the weather, so I'm trying to stay a little warmer today. But again, that doesn't stop us from doing a deep dive into tax liens. So I joke around that some of this stuff is fun to me. It's fun because I know how understanding this can help people, and that's what I enjoy doing. I'm a teacher at heart. That was actually my undergrad degree. I was going to be a teacher, and then due to political issues, they started firing people all across California, firing teachers, pink slipping them. So I decided to go a different route and sold my soul and became an attorney instead. So on that note, tax liens are a formal notice that you owe money to the IRS and or states. So they send you a warning letter, then they send a notice of filing of tax lien. When you get the notice of filing of tax lien, you can appeal it. And the instructions are on the letter. The problem with appealing a notice of filing of federal tax lien is it's really hard to fight that. So you have to argue to fight it. You have to show that, one, it's going to affect your livelihood, essentially get you fired, or greatly reduce your ability to earn income if you're a small business. They don't really like that one. But if you have a securities clearance, you are a financial advisor, you work in life insurance, any kind of licenses like that, they are very skittish. And if you get a tax lien, it can definitely impact your work. Sometimes you can work with your boss and try to keep that from causing you to be fired. Mortgage brokers, anybody dealing in the finance world, it can be a serious issue to have a tax lien filed. So stay on top of your taxes, talk to a tax professional if you do have any issues, and you can address it right away in most circumstances as long as the debt is not too high. So a tax lien it's not reported on your credit anymore since 2018. However, it is filed in the county where you reside. So can tax liens attach to property outside the county you reside in? Absolutely. It has to be filed in the county where the property is located. If the IRS knows about property, they will do that. So when the IRS files a tax lien, will it automatically attach to all property you own? No, not if the IRS doesn't know about it. But they're pretty good at doing record searches. I would assume if you have a tax lien, it's attached to most properties. But you can go to a mortgage broker, a title agent especially, and they can do a quick title search and see what's attached to that specific property. So if you have a tax debt and it hasn't been fixed, the IRS, they can issue a tax lien pretty much any time after they've sent you those notices. And there's times they haven't done it. They're getting more aggressive. They're filing more tax liens. They're taking more collection actions against taxpayers. But some of the things that will trigger a tax lien, if it hasn't already been filed, is to go in and do a non-collectible status. So when you go in and you set up resolution and you say, look, I can't pay anything, the IRS will automatically file a non-collectible status to try to protect themselves. If you have any real property, or if you don't, and that you're concerned you might have not disclosed everything, it's just a matter of course. Whenever you get a non-collectible status approved, a tax lien will be filed if it hasn't already been filed. So if they've already been filed, going into a non-collectible status isn't going to hurt you anymore. But that is something to be very much aware of, that if it hasn't been filed, it will be filed. So if you're concerned about a tax lien, it's good to check and see if it's already been filed. Many installment agreements will trigger the filing of a tax lien. You go, what? I'm promising to pay the IRS. Why would they hit me with the tax lien? Again, to protect their interests. You're not paying them immediately. You're saying you're going to pay them over time. So if you set up a partial pay installment agreement where you're not going to pay them in full, that's where they're going to deny that. They're going to deny, they're going to file a tax lien. So if you're not going to pay them in full, and if you owe more than $50,000, they will file a tax lien. Now they've actually tightened those rules up. So now to release a tax lien, you need to owe less than $25,000. But if you owe less than $50,000, you get on a direct debit installment agreement where they automatically take the money out of your account. You can usually avoid the filing of a tax lien. And they have new programs that outline that for you. Excuse me. It's called a streamlined installment agreement. If you owe more than $50,000, and this is the assessed amount, not the penalties and interest, and the IRS gets this wrong a lot. It's supposed to be based on the original tax balance. So if you owe more than that, then you're going to have a tax lien filed if you set up an agreement. So it can be counterintuitive. You work with them, and then a tax lien is triggered. So those are some of the causes of a tax lien. A lot of times if you get a revenue officer assigned to your case, then they will review it, see if any tax liens have been filed, and then file those that haven't been filed. Now, I mentioned revenue officer quite a few times. What is a revenue officer? I'm just going to explain this real quick. A revenue officer is when your case meets a certain threshold or complexity. So if you have business issues, and those can be handled by the IRS, but more and more we're seeing those being handled by revenue officers. If you have payroll liability, those will be sent to a revenue officer. Again, I have cases where the clients owe millions of dollars. Those are assigned out to revenue officers. It is a local IRS representative that, yes, can call you, will go to your home or place of business and conduct interviews, get information. Again, if you have a revenue officer coming to your door, you need to take that case very seriously, because the same person will issue all the bank levies, wage garnishments. Your case is in their hand. And I don't know if it was yesterday or Friday, I had one of my clients say, well, why don't we just get a new one? You can go over their head to their manager, but you really can't get rid of a revenue officer once they're assigned. So they issue a lot of tax liens. And again, for a business, if you're using a lot of credit, that can be a huge problem to have tax liens filed. That's why you need to be proactive, get ahead of this, work with revenue officers. I had a very long conversation that was very productive yesterday with the revenue officer. He had worked with me before. I didn't remember working with him, but he knew how I worked, that I worked proactively to resolve the case, not to just buy time and kick the can down the road. And we had a very good conversation. We even had the client on board. It was probably about a 45-minute conversation. And the client even said, wow, this was helpful, not what I expected. So once a tax lien is filed, what it does is it attaches to real property. It attaches to it's recorded with the local county recorder. And if you go to do anything with that property, transfer the title, sell the property, or refinance it, it's going to be out there. So another problem with tax liens is that it can show up when you're trying to purchase property. Now that it's required when you go to purchase a property, you have to have your last 3 years of tax returns filed. You do that, and it has to be disclosed to the mortgage company. Can you purchase property while owing the IRS or state taxes? The answer is yes, but you have to have a mortgage company that's willing to work with you. And we work with mortgage companies that work with clients all the time. And you need to have someone, you need to set up a resolution, an installment agreement to go in and get that. And we coordinate and work with the IRS, make sure the IRS is taken care of. And it takes time. If someone's not filing compliant, you have to file the returns. You have to go through that process. But once you get approved for an installment agreement, you should be able to purchase a property, a home. It just will figure into your income and expense ratio that the mortgage companies do. Now, if you get told no by a mortgage company, get a second opinion. We do work, and we do across the country work with mortgage companies that will work with clients with tax debt. Now, specifically, so that's how you purchase property with tax liens or IRS or state debt. If you own property, you can still buy, sell, refinance, change title, but you've got to work with the IRS or states, whoever you owe the tax debt to. And this is where it gets a little fun. So most of them will have a dedicated tax lien department. The smaller the state, the less refined it is, the less organized it is. So California, New York, they have tax lien units. The IRS has a dedicated tax lien line. And because the IRS wants you, believe it or not, they want you to buy, sell, refinance when you have a tax lien, because in most cases when you do this, they get money. So yeah, they want this to happen. So that's the perspective of the IRS and this tax lien department. They try to make deals happen. If you're trying to sell a property in so many days and you just enter an escrow, they'll try to jump on it. The more time you give them, the more likely you'll get it done. So try to, if you're trying to sell a property, you're trying to do something, get ahead of the game, get in contact with the tax lien unit, and that will help you get through this. So I'm going to even pull up some numbers here. For the tax lien unit, you can call 954-991-4008 or 1-800-913-6050. And that's the best way to get a hold of the tax lien unit. And they can either help guide you through the process, or ideally, if you don't even have to communicate with them, if you know which forms to fill out, how to fill them out correctly. Now, the fun thing about some of these forms is you need to process some of it and put in some of the information. The title company needs to provide a lot of the information for the sale. And then you need to get all the information back to the IRS. So you have to really be the intermediary. This is what we do, is we make sure we get all the information from all the relevant parties, get that form completed, and then send it off to the IRS. And we try to do that timely to allow for the sale or purchase of property. And I am past time. I'll be back shortly. Sorry about that, folks. Before we broke, I was going on about tax liens and got a little too into it and didn't recognize the break. So I'm going to repeat a little bit of what I just said before the break. There are absolutely ways to handle issues with tax liens. Some of these forms, you really have to quarterback it. So it requires information from the mortgage company, the title company, and then also from the IRS. So putting that form together can be a challenge. You really need someone and that's communicating well with the other parties. You need your title company to communicate well with your representative to make sure it's done quickly. So again, if someone's asleep at the wheel, that's a problem, especially when you have tight deadlines, when you have something in escrow and or you have a closing date. So make sure whoever you have representing you is on top of it, or you're on top of it, and that you get the right forms completed correctly and into the IRS. So I had shared those tax lien numbers. So kind of diving into this, if you're trying to sell a property, the IRS will absolutely work with you to sell a property. So when you, let's say you have a property, 100,000, you have a mortgage against it for 300,000. And you have a $200,000 debt to the IRS. Will the IRS allow you to sell that property, and how will that work? So this gets a little bit into the nitty gritty of the law, but there's a first. It all goes by priority on the loan. So the priority of the loan is whichever loan was used to purchase the property. So that loan is going to get paid first, and the IRS is not in. They're not in line first above the mortgage. If you own something free and clear and there's a tax lien, the IRS can have first priority. But usually there's a loan, a mortgage, or a debt to someone else. So let's say you take this property and you want to sell it. You go to the IRS. You say, "Hey, I need to get rid of this property. There's a $300,000 mortgage on it," and the IRS will say, "Okay, go ahead and sell it. And after closing costs, after all that is done, let's say you get 390,000 or 385,000. The mortgage will get paid off first. If there's a first, there's a second, whatever has attached prior to the tax lien, that will get paid first. And then the IRS will get paid whatever's left. So if you owe 200,000, they'll be more than happy to take 85. It's just that they will get paid before any profit goes to the owner. So it's a good way, if you have extra property, you can sell it, pay off your debts, and move on, and then not have to deal with ongoing interest and penalties. What if there's no equity in the property, or very little? So if you're selling the property and it's worth about what it's, you're doing a short sale or doing something else, will the IRS work with you if they're not getting paid? Yes, they will. They still want people to be able to buy and sell property. If it's an economic burden or whatever, you don't have to justify it, but you can say, "Hey, I'm selling this property. Sorry, there's very little equity left over for the IRS. If you're not paying off the loan, you have to do a short sale or something like that, and that's another process." But the IRS will work with you to lift the tax lien so that you can sell the property. Now, what if you're not the only owner of the property? So let's go back to our previous example. Property's worth 400, you owe 300 on it, but you're not the full owner. You purchased it with your brother. All you have to do is show what percentage you owe in the property, or you control in the property. So in that situation, let's say there's 390,000 of profit from the sale of the house after closing costs. 300,000 goes to the mortgage. The other 45,000 gets split between the two owners. So your brother will get 45, and then your 45,000 goes to the IRS. So they understand that you have multiple owners. People don't always own a property by themselves, and they will work with you to buy, sell property. What if you need to refinance a property? So we talked about priority on a loan. So the purchase money order or security, whatever you use was to purchase that property, has priority. But let's say you purchase the home, and then later on a tax lien gets filed, and then you want to refinance. So this is very popular 5 years ago when the interest rates were very, very low and everybody wanted to refinance. Will the IRS work with you to refinance a property? Right now, nobody wants to refinance because the rates are high, expensive. But absolutely, the IRS will help refinance a property, even if it just lowers your interest rate. So even if the IRS doesn't get any benefit from it, they will work with you to refinance a property, give you a lower interest rate, because that helps you pay your taxes. If it doesn't hurt the IRS, they will usually try to work with you in the tax lien department. Now, if you are, see, when you refinance it, you're taking the refinance and you're putting it ahead of the IRS in priority. So you have the purchase money security or the loan used to purchase a property, then comes the IRS, then the refinance would come after it. But using what's called a lien subordination, you switch places. And the IRS will allow that to happen, especially if you're going to refinance and take any value out. If you're taking equity out of your property and you can use that to pay the IRS, they will absolutely work with you on that and allow you to take money out, pay your tax debt, or pay it down and then move on. Now, the tax lien unit, they're not part of collections. They just look at it and say, hey, is this beneficial either to the client or the IRS? If it hurts the IRS, they won't do it. If you're taking money out and paying off something else that's not a priority, they won't do it. But so you can purchase, you can sell, you can refinance, you can transfer title, but they either want to show that there's some kind of even exchange. Usually that's more of a there has to be some kind of exchange there that doesn't hurt the IRS. So that's what you need to be looking for, and that gets a little trickier to convince the IRS, hey, this is a good thing for the IRS. But again, you can't do any of those things legitimately without dealing with the IRS first. You go to the county recorder. They're not gonna sign off on it because you have this tax lien sitting on your property first. Same thing as if you have a mortgage, you have to go through the mortgage company to change the title and who's actually on a property. But again, you can work with them. It can be done, and that's something we do on a regular basis. So when it comes to real property, the IRS actually does try to work with people because usually the IRS gets paid something, or they make it more affordable for you to pay your taxes. So what are the forms and how do we do this? So when you need to work directly with the tax lien unit, you need to call them. They're overwhelmed like most areas of the law, but you need to follow up with them. If you fax in a form, they will respond to that. So the fax number is 855-851-8235, and then you have a fax link for the advisory lien department at 844-201-8382. The form number is 12277. So when you're preparing your documents, just make sure you have the right form, that you're sending it to the right place, and you don't need this form. Well, that's for an application of withdrawal of taxes, a form 12277. That's if you're trying to get rid of it. If you're trying to subordinate the lien or work with them, it's form 14134. So again, that's the fun form. It gets a little bit more complicated as you work to try to get that addressed. So the 12277, we're going to talk about that next. This is where you're trying to remove a tax lien. So when can you remove a tax lien? When the balance is paid in full. And normally tax liens should come off 2 to 3 months at most. If it's been more than 3 months and hasn't come off, call the tax lien. You file the form 12277, and they will remove the tax lien, or they should. If you set up a direct debit installment agreement and you've made 3 payments that are being taken from that direct debit, once those 3 payments are done and you owe less than $25,000, they will remove. You can apply for and get that tax lien removed. The IRS has kind of tightened up those rules, so you have to meet those very tight standards. And you have to have a good history. If you've defaulted multiple installment agreements, they won't release the tax lien. So those are the 2 main things. Or if you've settled through an offer and compromise. So when you do an offer and compromise and it's successful, it wipes out the liability. You can go and remove the lien. Or if the tax debt is expired. Happens all the time. So you have that 10-year window. And that's just an estimate because there are things that could extend that out. But once that's done, you can go in and file the Form 12277 and get that tax lien removed. So same thing with the states. Again, the states are harder to work with. Harder to get that information. But if you do have those issues, if you have tax liens that you're dealing with and you're trying to buy, sell property or give it away or anything, you need to work with them. Otherwise, it's not going to happen. So here's a little trick that I use all the time. People are renting and they want to purchase property. That's one of their goals. It helps them qualify for a better offer, for a better resolution in most cases, to get them into a home. It saves them on taxes because now they get to deduct the interest, mortgage interest, and it also saves them moving forward on. Again, you usually have you're building a future, you're building interest value in them. So there's a lot of home ownership is usually a great thing for them. Sometimes people they've got a situation where they're paying very low rent and they're getting by. But if they purchase a home, often their allowable expenses go up and it helps them qualify for a better resolution with the IRS. So I would much rather someone get in a home and pay the IRS less. And I've done this plenty of time. We're off with cases where we'll get an installment agreement, set that up, get them into a home, they'll purchase a home, and then we turn around and do an offer and compromise and wipe out the liability. You can file an offer when you're in an installment agreement. You can file it when you're in non-collectible status. You just want something set up to protect you from all the collection actions that we talked about yesterday. So as far as tax liens, we've kind of covered it. I mean, again, each case is unique. You can have tax liens filed against your property that you didn't know about. I had one case where someone put their name on the property and took it off in less than a year. Their name should have never been on the property, but a tax lien was filed. And so it was a fight to get that removed. We were eventually able to do it. But again, it was a very tough situation. It wasn't your normal run-of-the-mill thing. So there are other situations where you need to get someone's name off a property. And if it shouldn't have been there, you can file to get that tax lien removed. So when people try to sell property and it's an estate, that's another big issue where we see tax liens come into play. So if the person that passed away owed taxes and tax liens were filed, the state absolutely has to deal with the IRS. And if we're selling property, it's easier than just doing a form. You just have to do a payoff calculation. You have to get that from the IRS, get those numbers, send it directly to the title company. And usually those are good for 30 to 45 days. And they'll use that to pay everything out once they pay off the escrow and all that. So again, if you run into a mortgage company that's skittish about that, they're not sure, or a title company that doesn't know, get a tax professional that's used to communicating, used to quarterbacking the whole process, and can work with everybody involved, the state, the IRS, and can make sure that sale of that property goes through. So then what's left over can be distributed to the beneficiaries. Or if maybe it all goes to taxes and what's left over, if the estate can't pay the taxes, then the IRS is just out of luck, or the states are out of luck. So when someone passes away, their estate gets distributed, all the debts get paid off, and then what's left over should go to the beneficiaries. If there isn't enough left over, the IRS or states often get left holding the bag. And that answers another question that we frequently get. If someone passes away and the debt was solely under their name, are the kids, grandkids, spouse liable for that tax debt? Absolutely not. It goes under their social, and anybody tells you otherwise, and I have had people tell me the IRS has told them this, or other representatives, there's a lot of bad information out there. If you're not liable under your social security number, you don't have to pay it. And this also goes, the state might have to pay it based on, the value that they owe, or whatever value was in their name. But again, it all follows the social security number. Same with tax liens. They follow the social security number, or EIN, if it's a business that owns property. And so that's how you trace it, make sure who's liable for it and how to address the underlying issues so that you can move on. So we're coming up on another break in a couple minutes, and we're going to talk about some leftover tax issues, collection actions that are less common, but still very nasty. The lock-in letter is one of the worst ones out there, and the IRS has stepped up their game, and this used to be very rare. They've been doing this more so, and we're going to talk about that and then just kind of wrap up how to deal with different collections and other issues. So, we'll be back in just a short while. We do have about another minute or so before we break. Again, if you have questions, call us. Most people don't believe it, and when they call in, we have a free consultation. So if someone calls in and talks to us for 40 minutes and they're like, oh, I need to bring my husband or my wife into it, we'll do the same thing for the husband and wife. Explain everything, make sure that you fully understand what your rights and options are before we charge you a dime. So get informed. The second opinion, if I repeat this a lot, is because it's important. I just wrote something up where, again, time and time again, I said, get a second opinion, get a second opinion, get a second opinion for another blog post and podcast. So again, if you have questions, you're not sure what you need to do and how to address a certain situation, call, get some free advice. If we don't handle it, we know who can. And, we'll refer you to excellent professionals that can handle your case across the country. Again, 520-485-7371. Thank you for watching smartmoneyculture.tv, and we will be back in just under 4 minutes. Welcome back, everybody. Thank you for those that are watching on broadcast or rebroadcast or watching live. So we're just going to try to wrap up what other collections actions the IRS can take. So the first one is called a lock-in letter. Now, it doesn't sound that bad until you understand what it does. So it's rare. The IRS has started to do it more, but it's usually when someone has a history of under withholding. So they're claiming too many dependents. They're not having enough taxes withheld from their check. When someone is doing that, the IRS can issue what's called a lock-in letter. It locks you in at single and zero. So as long as you're at that job, you will have the maximum amount withheld from your paycheck, which means it's going to force you to have big refunds, which the IRS will then take those refunds and apply it to your past due taxes. So, and this goes to the state. So, how do you, when a lock-in letter is issued to an employer, they have to put it on. They might drag their feet a little bit, like they might, with the garnishment, if you know them, there might be friends, but they have to do it because if they don't do it within a reasonable period of time, they become responsible for it. And most people, even though they might like you, they don't like you that much. They can't afford it to take that responsibility on. As a company, there's usually penalties, severe penalties that go with that if they do not enforce IRS collection actions. So with a lock-in letter, you can appeal it. You can fight it. It is not easy. The process is very difficult and complicated. You have to produce your financial information. You have to show that you can't qualify. You have to show, and it's not a normal appeal. It has to go through the IRS appeals process. It will take months, if not a year or more, to contest a lock-in letter. So again, it's something that if you can't afford it, it can really kill you. So I had a true story gentleman who worked for the railroad. He had good income, and for quite a while he was single. And then he got married. His new wife, they had kids, and that's when the IRS hit him with the lock-in letter. So while he was single, he was doing fine, didn't have to worry about it. And yes, he was under withholding on his taxes, accrued a bunch of tax debt. Then he got married, tried to, once that lock-in letter hit, he couldn't adjust things. So now being single and zero, they were taking so much out in taxes that he was really struggling to provide for his family. So because they did that to him, we had to go through and appeal the lock-in letter to try to get that released. So again, not an easy process, a pretty nasty process. We've seen it where a revenue officer issued a lock-in letter on the way out of a case when they weren't supposed to. They said they weren't going to. And that, again, very nasty issue trying to get that removed. So again, if it's under withholding usually does not pay, it usually causes you a lot of grief in the end. Offset letters. So the IRS and states love to work together. Believe it or not, they share information. So if the IRS does an audit or underreporting, they will share that with the state, and the states will usually follow suit and also do the same thing to you that the IRS did. So if you have an issue with the IRS, be very careful about it, because if it's not resolved in your favor, expect the state that you have to deal with the states as well. But what an offset letter is if you get a refund with the IRS, they will take whatever, instead of sending you the refund, they'll send it to the states, and vice versa. If you get a refund with the states, they'll send that to the IRS. So they all pretty much have this agreement, offset agreements. They will send you a notice of offset, and then any refund you get will go to pay off your IRS or your state liability. Can you contest an offset letter? Not really. Once they put that into place, do they always catch all the refunds? No, but once they put that offset in place, then it's going to go to the state, or from the state to the federal. And then the best way to do this is you have to go and you have to negotiate with either the state, IRS, get that taken care of. One big case I had, and this is be wary of the IRS or state just telling you, oh, go do an offer and compromise. Not everyone qualifies for an offer and compromise. And to qualify for the offer and compromise with the IRS, well, with the states, is much harder. Some states just won't do it. Arizona has an offer and compromise program. We've gone through people that qualify, they should have gotten accepted. And then the offer specialists there said, we don't like to do them. We're not accepting. I said, well, why not? It follows your rules. And like, yeah, but right now we're not, this administration, we just don't want to accept them. There was no appeal process. There was no way to get around that. Even with the IRS, they do have an appeal process, but within their unit. Once you exhaust your appeal, you can't go to tax court. You can't fight that any further. That's their answer. Their answer is their answer. So that's why it's so important to get as many bites at the apple as you go through the process. But if someone says, oh, just accept the liability, you can file an offer and compromise on it. So true story, this guy was told he had a court case going on, and he was able to settle with the IRS. And they told him, look, you can just do an offer and compromise. And he had a franchise tax board case. The franchise tax board, California, was following suit, and they were just piggybacking right off of what the feds are doing. They told him, well, you can just do an offer and compromise with the state of California. Well, they have an offer and compromise program with the state. It's horrible. He didn't qualify. And even though he got a deal and he was able to settle it with the IRS, he got smacked hard by the state of California and is now paying the whole balance. So when someone tells you, oh, you should just file an offer and compromise, understand that the people, when you call in, you're talking to the main IRS line, you're talking to collections, you're talking to a revenue officer. They don't know the offer and compromise program. Yesterday, I was talking to this revenue officer, 20 years experience with the IRS. He knows what he's doing because he's a revenue officer and that's what he does. He suggested to my client, why don't you just file an offer and compromise? This is a large case, 1.8 million. And I had to explain why he didn't qualify. So he had about 300,000 extra every year at least. And the IRS could easily show that over 10 years, he could pay the 1.8 million. And they would easily reject that offer. So that's the difficulty there, is you have to understand that the IRS, when they suggest these things half the time, and I hate to say this, they're telling you this stuff to get you off the phone. When someone's upset, how am I going to deal with this? How am I going to address this? And it really irritates me when they do this to people, because then they call me up and they say, hey, they said I could do an offer. They said I could do an offer. I said, well, let's go through your financial analysis. And most of them don't even know how to do it for an offer because it's different. There are twists. Overall, the information is the same between doing a non-collectible status and an offer, but there are plenty of things that you can get by with in a non-collectible status or installment agreement that you cannot do with an offer and compromise. So be very wary when they tell you, hey, just go do an offer. Usually they're blowing smoke at you. So that's why it's so important to go through, do a thorough analysis. Someone tells you go do an offer and compromise and you have not done a thorough analysis with them, they don't know what they're talking about. They're either selling you something or they're trying to get you off the phone if it's the IRS or state. So there are states that have decent programs. New York is one. We've got them accepted in Kansas, some other states as well. But it varies by state and it varies greatly. So just because someone, don't just listen to it, don't just bite into that. I had someone, the same guy that got hit with California, and he wanted to, someone else told him that he should try for an offer and compromise with the state of California. We already had the case. We had already dealt with the IRS. Now we're dealing with California, try to wrap that up over $100,000. So large case for the state. And I got on the phone, like, who is this joker telling my client what to do, what not to do? And he says, well, I'm retired. And sometimes, you just file stuff and see what sticks. Okay, my blood started to boil. I'm like, really? You're going to charge clients to file stuff that you don't know whether or not it's going to work or not? There's times I do that, but when I do that, I'm 100% upfront with my client. And I explain the pros and cons and say, hey, sometimes when we're doing an abatement, we're going to try to get hundreds of thousands removed. It's a lot of work, so I'm going to charge you for it. But this is a possibility. I want you to go in with your eyes open. As far as an offer and compromise, if you haven't done the analysis, if you don't have a good idea if they're going to qualify or not, you're wasting your time. You're charging your client for something that you know isn't going to work. If you don't know, you don't know what you're doing. I'm sorry. When people push products and they don't really, they can't explain it thoroughly to you, get a second opinion. Find someone else that can explain it to you and can make it. Again, a highly intelligent person can make the complicated simple, and and at least explain it. Again, that's the same for any industry. So, true story. We went in, and this guy told me just file it, see what happens. And I said, look, I'm not going to charge you for this because I don't think it's going to work. I'm telling you, no, it's not going to work because I know the analysis, I know your numbers, and I explained it to the guy. And he's like, sometimes I just throw crap against the wall and see what sticks. I'm like, that's a horrible way to run a business. So we filed it. It got rejected, as I told him it would. Again, we did our due diligence. We went through the process, and then we set up another resolution afterwards. But again, it just drives me nuts when people do half measures. They don't do a thorough analysis. They don't warn people. So again, if they're not warning you through the process, if they're not giving you the good, the bad, the ugly, get a second opinion. So again, we're almost out of time. And that pretty much wraps up tax liens. That wraps up a lot of the collection issues. So we're going to do a deeper dive. And one thing I realized is that we did not go over the offer and compromise forms themselves, how to fill out the form. So we're going to go through line by line and explain how to fill out the actual forms tomorrow. So if you're interested in filing an offer and compromise at all, this is going to be a great program to listen to tomorrow. There's two forms of 433A, that's 656, and it's a 433A in parentheses OIC. Make sure you have the right form. Otherwise, they'll just kick it right back to you. But thank you for watching. And, it can be very stressful dealing with IRS taxes, state taxes. But there is a light at the end of the tunnel. There's always some way to resolve it in almost all cases. And, call and get that free advice. Sit down and talk to someone and find out what your rights and options are before you just roll over. And again, the IRS gives horrible advice all the time. Now, once in a blue moon, you'll have someone that calls in and their IRS helps them out. There's times where I call and someone calls me and we go over their financials, and especially if they're already on an installment agreement. If you already have something out there, if you can't afford it, you can always get a second opinion. But if you can afford it, and someone's saying, look, I can lower your payment by $50 to $100, usually isn't worth it, because in the end, it doesn't make sense with the fees they're going to charge you. And that's for anybody. So I have plenty of times I go through and I do an analysis, and then I'm like, look, I can only save you this much based on the numbers you have. We can try to move the numbers around. But if you don't want to do that, that's really what you're looking at. So again, follow your gut. If you don't feel good with someone, get a second opinion. If you question their experience and their ability to teach you through the process, you don't have to become an expert, but you should learn as you go through this process, want to avoid the issue and make sure you're never going to end up back in that situation. I think that's the mark of a true professional, is that they help resolve the immediate issue, and then they prepare the client for the future and educate them that way. They're not going to end up right back in the same situation. So tomorrow we're going to tune in and we'll walk through the offer and compromise documents step by step. And again, there's going to be variations depending on the particulars of your case. But again, it's going to be very informative and really help people make sure that they prepare their documents right, because that is a huge first step. A lot of offers just get rejected because people don't know how to prepare them. So again, Hubert Johnson with Taxes Made Easy. Our website is guardiantaxlaw.com, 520-485-7371. And thank you for watching smartmoneyculture.tv.